Hey guys, this is Phil at the Laptop Trader channel on YouTube. Welcome back to our community. I was up late, so I decided to maybe give you guys an April update video on market trends and things that I saw changing. Again, here to give back to the stock investing trading community one video at a time, um, and just using some tools to create confidence by putting the odds in your favor. So good luck. My email contact laptoptraderphil@gmail.com. Caution, most stock traders lose money. Please protect yourself at all times. Okay, nothing discussed. This video is trading or investing advice. Remember, invest in yourself and then invest in the markets. So let's get to a few items here that are on my mind. Again, if you don't have a platform, in my opinion, I think a platform is very helpful. I have no affiliation with barchart.com, but it is one that I like to use. They have three different plans. They have a free plan where you're going to get just a starter membership, and yes, you'll get ads with that, but it has a lot of nice features for free. Plus is only $9.99 a month, or $99 per year, and then Premier gives you all the features of the site for only $29.95 a month, or just under $200 per year. So again, no affiliation with that, but it's a tool that I use and I find very helpful. So let's get to some charts for you. Let's just go over what happened this past week. So we had a lot of volatility. We had some wide range bars, right? We're down, kind of up and down on Tuesday, gap down and close with this very large green candle or green bar on Wednesday, and then two inside bars compared to this large candle on Thursday. And Friday we closed green, so that um, you could just see the volatility on the chart. Now, if we go back to December, when really this downtrend kind of started in the overall markets, we could see it started with this tight price range and then a red igniting candle down. So this candle spelled trouble to the downside for stock investors, right? And then we went through this period of back and forth, a little bit of increased volatility. It looked like right here in February, like we were going to maybe continue higher. We actually made a new high in February. And then the bars of the candles, the range expanded again to the downside. So you can see how these candles got tight. We made a new high and then they just price sold off very quickly. We also had another clue, right, as a price detective, that we had this red, green, and red where the buyers were sandwiched. So I call that a 3-bar sandwich, and then it just kind of prices then continued downward into March. Okay, so now we're in April, and we kind of have this back and forth here, where clearly the buyers are trying to step up in this area. Okay, right? We had some buying here, then we had some selling, and then the buyers just kind of took control right here. So this is looking like, in the short term, like at least the buyers are trying to step back into the market. So now let's just go out to a higher time frame so we can get some context of this move. So I'm going to look at a weekly chart real quick, and you can see the volatility since mid February has really picked up. Right, this volatility is really high, and this expansion in price has created that volatility, and that shows up on the VIX. So here was, a big wide range expansion bar to the downside, and then we had this wide range green bar back to the upside. We also have increased volume the last 2 weeks. You can see the volume has really picked up. So there's a lot of activity right now. I'm not saying we're out of this bear market, but there's some signs that buyers are at least trying to step up at this point and at least engaging in the battle. Right here, mid-February until last week, the buyers just weren't present. It's just like sellers were clearly in full control, and you know, maybe even for the next few weeks, sellers will still be in control, but at least the buyers are pushing back. On the monthly chart, we had this uptrend right into December, January, February, slight new high, but we had this tight price action, and then sellers took control in March without question. And now in April, they were in control, and now we're kind of at this midpoint of this monthly bar. So right now we're at a bit of a stalemate on the monthly chart, where buyers and sellers are going back and forth. Okay, but you could clearly see the volume increase, and we're halfway through April, so a lot of trading taking place in the markets right now. Let's just look at a few more charts so we get this context. Okay, market context. We're trying to establish our bias. Is the market going to go up, down, or sideways? Right now, it's still in this downtrend, right on the NASDAQ QQQs. So that is, until this downtrend is broken, our bias would still be slightly to the downside. But again, buyers are starting to step up. Why is that? Because they're starting to see value at lower prices. The IWM small cap index ETF is still in this downtrend. A key level to watch on this one is around the 161 area, give or take a point. You can see that line I drew here very clearly where there was previous support. Okay. The DIA Diamonds ETF is still in a downtrend for the last couple months, but again, buyers are starting to push back, as evidenced by this this bottoming tail. So you can see this on different time frames. I hope this helps you out. Transports are still in a short-term downtrend. So those 5 main indexes are still in a downtrend on the monthly chart. Okay. Now let's get back to. Actually, let's just stay on the monthly chart. That's okay. We can do this with the monthly chart. Aurora Cannabis still in a sideways stage 1 flat trend. A marijuana ETF MJ still in a stage 1, maybe even still stage 4 sideways or downtrend. This is a mortgage company. It's still in a longer term downtrend. Okay. This is a real estate company. Basically a really big sideways trend. The thing I don't like about this chart is this igniting bar broke all this previous support to the left. Now, buyers have stepped up a little bit this month to try to push that back up. We'll see if this is more of a shakeout candle, and maybe next month this turns green again, but that remains to be seen. It did have a positive close on Friday. UPS still in a downtrend on the larger time frame. Pfizer just made a new low this month. NDAQ, which is NASDAQ the company, still in a short-term downtrend. Cardinal Health, still in an uptrend. So this is more on its own page. Okay, so this is one of my recommendations going forward, or suggestions. Not, I shouldn't say recommendation, but this is one of my suggestions going forward. Cardinal Health, I like this company. Okay, one, they're in the medical sector, so that generally has a at least some safety just in the fact it's in the medical sector. Number two, it's still in an uptrend on the monthly and weekly time frame. Okay. Yes, there has been some selling in March into April, but now we've got this reversal candle, and we'll see if price can continue up. Other thing I like about Cardinal Health is the fact that let's just look at some quick metrics. Now, the daily time frame does not look great for Cardinal Health, but we had this reversal, this gap down reversal on Wednesday. We had an inside bar which closed near probably the top 10, 20% on Thursday. And then Friday we had a another green candle that closed above the previous 4 days. So I like this price action there, showing that buyers are willing to buy at this price. Let's just look at some quick metrics. This page will just kind of show, performance over the last 5 days, some volume, average volume. So volume is about average. We've got a performance page. I like this page too because it gives you some different time frames of, what has this stock done over the last 1, 3 month, and 6 month periods. Also over the last 1, 3, and 5 years. So what do we see about Cardinal Health? It's all positive, right? Over every time frame. So that's a stock that has some relative strength. You can click on different things like news. We can look at, I guess you could look at options if you're into trading options. Some basic options information there. I like this page, the key stats. It shows also different returns as a percentage over these different time periods. So in 1, 3, and 5 years, we've got a progression of the returns going up, right? So we got 23% and 109% and then 157% over the 5-year period. So that's really solid numbers there for Cardinal Health. But I like this too. It shows revenue growth, double digits over 5 years. Earnings growth, double digits over 5 years. Dividend growth, that's a very low percentage for dividend growth, but they are growing their dividends at a slow rate. I also like this page where it shows market cap, $31 billion company, so it's a large cap company. Shares outstanding, 241 million shares. Annual sales, 226 billion. So we have to add in this M. So that's for million. So you just add in some zeros to that. And I like their sales versus their market cap. So we got 226 billion in sales. We've got a 31 billion market cap. I like that because that's a lot more sales than what the company's actually valued at. That's what market cap is. That's how they value companies. And then they've got net income, last quarter sales, and last quarter net income. So what do I like about these numbers? I like that last quarter net income, $400 million. Annual income, $852 million. So what do I see there? I see in the last quarter or 3 months, they've earned almost half of their annual net income. So it looks like they're very profitable based on those numbers. And then we've got some ratios on Cardinal Health. We've got, fairly low price earnings ratio or PE ratio, 16.6. Forward, it's actually going a little bit lower. That's okay. PE versus growth, 1.7. That's okay too. I like that closer to 1 or below 1, but that's still okay. This is a very large company. I don't like this number. I'm not even sure that's accurate, but return on equity, minus 59. To me, that doesn't add up to everything I've already seen with these basic numbers, but that could be right. I'm not sure on that. Return on assets is fairly low, and profit margin is quite low. So if they can increase their profit margins and improve their equity, maybe they have some extra debt. But right now it says debt versus equity is a minus number, so I don't really understand that. But price divided by sales is very good. 0.14 is very good price divided by sales for this large of a company. 12.2 price divided by cash flow is a fair number. Book value minus 12, I'm not sure about that. In interest, so there's some interest in large analysts to follow this stock. But I really like the sales. I like the PE. So the numbers look fair to me, or even low. Like this could be a good value at this time. But most recent earnings, it shows this number here. Next earnings is on May 5th. What, about 3 weeks away? Earnings per share growth versus previous quarter. Now this I'd like to see more double digits. I think that this moving up would help the stock. Same with this number, 6% growth over the previous year in earnings. I think that if that was to get up, above 10 or 12 or 15, that would really help the stock. So there's a lot of ifs with this company. But they do pay a small dividend. They pay almost 19.5% of their earnings back to investors. I would say that's a fair number. So they're not giving everything back to investors, which means they should be reinvesting in the company. And they have a 1.5% dividend yield. So this is not a crazy high yield, but it does have some yield to it. So if you like, a company with some potential, I think Cardinal Health kind of gives us that potential on the fundamental side, and also the fact that this company has, recently survived and even kind of thrived during a weak market. So I like that about Cardinal Health. So that's just some quick and dirty numbers on a potential idea if you like a longer term stock. This is not a fast growing stock, but so far it's been pretty steady. Versus refi, which is kind of testing the lows, right? So that would be relative weakness. So this would be a relative strength stock. This would be something that is relatively weak versus the market. Okay. Uber, I like a lot long term. Currently, it's in a range between about 84 and 61. So it has a fairly wide range. Right now, it's trading towards the middle of that range, but I like their metrics also. Let's just compare the metrics of this company versus Cardinal Health, and I think you'll see some differences. Now, remember, they're in different industries totally, but just based on numbers, we can look at some different things. Now, Uber, over these different periods, has done fairly well over the last 1 and 3 months. Over 6 months, it is negative, and over 1 year, it's negative. But over the 3-year and 5-year period, it's very positive. Okay. Then I usually go to the key stats area. And here again, we can see in growth, 1 year, not great, but 3 and 5 years, very good. 5-year revenue growth, I like that, triple digits, to over 210%. And 5 years earnings growth, right, triple digits, over almost 167%. So that's quite a bit more growth than something like Cardinal Health. Now this is going to have a little bit different market cap versus Cardinal Health. This is going to have 151 billion market cap versus 43 billion in sales. Okay, but that's still very respectable. Annual net income 9 billion. Last quarter sales 11 billion. And again, last quarter net income 6.8 billion. So last quarter they had a very good net income versus their previous annual income. That's like 2/3 of their annual income came last quarter. So I really like that. Let's look at the ratios. So ratios just take all these numbers and put them into a ratio form, right? I like this. Debt versus equity, very low debt, less than 1. Price versus sales, right? 3 times price. 3 times sales is the price of the company. So that's not out of line. I prefer, in a growth stock, I prefer something less than 1. But Uber's a growth stock, but it's also a pretty established company at this point. So I think that's a fair number. 14 times cash flow, I feel that's a fair number. Book value, I don't pay a lot of attention to. And interest coverage, so this is followed by, several analysts on Wall Street. I like this too. Now, some people get kind of weirded out about PE ratios, but the previous company we looked at, the PE between this one, the trailing 12-month PE, and the forward PE was actually going down, okay? This one, the trailing 12-month PE is 15.5. Going forward, it's moving higher. Now, that's not necessarily a bad thing because as that goes up, it means a lot of times it means the price is going up versus the earnings, which means if you own the stock, your value is going up too. But PE, I don't get hung up on PEs. I just want to explain that to you that an increasing PE can be a good thing, right? Especially if it's fairly low, like 15 going up to 28. That means price can be growing. It can also mean earnings are going down. Now that remains to be seen. I like this too, the PEG, price divided earnings compared to growth, 0.78. I like that a lot. That's below 1. Return on equity is very high. I like that a lot. Usually over 20 or 25 is really good. So that's really good because this is a large company. They have a nice double-digit return on assets and this double-digit profit margin. I like that a lot. Per share just shows most recent earnings, next earnings date, May 14th. So that's an important date to watch out for. And I like these numbers a lot too. Earnings per share growth versus the previous quarter, triple digits, right? Earnings per share growth versus previous year, high triple digits, almost 400%. I really like that. Remember, Wall Street really likes growth. So I like this one too because where the chart's at in this range, we're kind of in the middle of that range. I could see a lot of upside potential for Uber going forward. Now, this one does not pay a dividend, so that'd be more of a growth play for Uber going forward. AT&T, I think this is seeing a significant increase in price over this period, and I think there's definitely going to be some selling or some profit taking coming into AT&T, but that was a bit of a surprise, to be honest. But there is still the potential for future price growth in AT&T. DoorDash is in pulling back here over the last 2-3 months, so we'll see if that gives us an opportunity to enter DoorDash later on. This is a small streaming service, Curiosity Stream, which is in basically stage 1 at this time, so we'll see if that can pop out of that area for growth opportunity. Consumer staples have just been kind of back and forth over the last 6-8 months. Here's another play I like long term. CVS company. It's like your local, not local, but national drugstore, kind of convenience store. Competes with Walgreens. Let's take a look at a few metrics on CVS. Performance-wise, I like that it's had recent outperformance versus the market, right? 1 month, 3 months, 44% increase in price, and 6 months, 4%. So in a market pullback, right? The market, I believe the S&P has pulled back about 20% and then kind of snapped back up, but this has outperformed the S&P over that period of time. Let's look at some key stats quickly. Again, growth, 1, 3, and 5 year, not great. Okay. In fact, underperformed the market over this period of time. But I like this, 5-year revenue growth. I like earnings growth is negative over the 5-year period. I don't like that. I think that's terrible. They have grown their dividend double digits over that 5-year period. So this is a valued at an $87 billion company, okay? Last quarter net income, $1.6 billion. Let's look at some ratios of CVS. So PE, right, is fairly low. 12.7 PE, that's pretty on the low end. PE forward is actually lower than that a little bit, so that tells me that maybe either earnings are increasing or price is decreasing. The PE to growth, I like that, just about 1. Return on equity, about 10%. not high, but fair. Return on average, return on assets is fairly low. Profit margin is fairly low. Okay. But they have low debt. I like the price divided by sales number there. And all these are, fairly low numbers. There's nothing that I see here that scares me as far as maybe like a high debt load or something like that. I don't like the low profit margin. I'd like to see that increase. If they could increase their net margins, that would do a lot for this company. And per share, they have earnings coming up again on May 1st. I don't like this EPS growth versus the previous year, that negative. I doubt, like I said, if they can get their earnings per share going the other way, net margins going the other way, that would do a lot for the stock. It does pay a fairly high dividend yield of 3.8%. So this has some kind of back and forth on the fundamentals, but I like the chart at this time because it looks like we had this area that kind of bottomed out, made a new low in December. Since December has been outperforming the market, right? We had a low in December, large wide range red bar after a downtrend, right? And then we kind of reverse course. So as the market has went down, this stock has started to move up. And that's one of the main reasons I like this stock. If we look at a daily time frame, we can see we had a nice reaction to earnings. That's another thing I like to look for. Did the earnings reports react positively or negatively, right? Did price move up or did price move down into earnings and after earnings? Well, into earnings, price gapped up and has since basically held that level. We had a slight sell-off here, like a 3-day sell-off, which price tested this area and snapped right back up. Made a new high, then we had a gap down reversal candle, and then 2 inside days. So to me, I added to my position on CVS on Friday. I thought this was very good price action. This looks crazy, but when you really read into it, it's actually, okay, we made a new high, gap down the next day. Buyers really liked the stock. They bought it up, and the next 2 days it consolidated. And as it consolidated, volume decreased. So I like CVS here at this price. I think it's a fair value. So that's an idea going forward. Gold just made a new high Friday. Celsius is another idea I like. This pattern, if I could draw a line, which I'm not going to, but I'll just do it with my cursor. Good reaction to earnings. After earnings, it did sell off, but held this level, which is essentially a higher low than this level. And then price moved back up, tested this area after earnings, and has since consolidated for about 2 to 3 weeks here. And if you read this price action, we had a gap up, close lower, then we had a gap down, range expansion bar, right? So this kind of gap down and reversed higher, and then we have 2 inside bars. So I like this company at this price at 37 or higher. We also have these oil stocks have not performed. Insurance, this one's kind of back and forth. This is a stock I also like, Alignment Healthcare, based on the chart. You can see this positive reaction earnings, sideways, move up, pull back to this moving average, and then a gap up, new high, and gave us kind of this 3-bar turn, and then kind of this inside bar on Friday. So I like that over 1975. ALHC is the symbol. Mercury, also positive reaction earnings, but then sold off. Has been sideways ever since. Is kind of gapped up and closed higher Friday versus this area. So I like that over, let's see, over 46.50. I like Mercury, system symbol MRCY. This one would be just a watch. American Rebel Holdings right now, just a watch based on volume and where price is at right now. If this Starts to turn up again. I like that over $11. AREB. And Hydrofarm Holdings, I like this. Even though it's in this downtrend on a daily time frame, I like this price action here on Wednesday, Thursday, and Friday. So those are just some ideas looking forward for you guys. I hope that helps you out. I hope that gives you some context of the market. I share with you some tools that I use. I've got a fairly large watch list of different companies that I watch. Right now, small caps seem to be starting to perform, right? This company, MAPS, right, we had the sideways price action. Wasn't much of a reaction at all to earnings, and then this week gapped up, made a high, and kind of held that area over the last 4 days. Again, small cap would be, I'll show you the value of this company. This company is valued at, this is only $159 million company, annual sales of about $184 million. So I like that because that gives us a ratio, price versus sales of less than 1. So I kind of like that. So when I look across, and I'll look at hundreds of charts when I'm studying, but this is also a small cap company starting to perform. AGL starting to perform. I think I have to refresh this page because it looks like all these charts look exactly the same. But let's just look at this again. Make sure we have the right information. Yeah, see, so this is still on daily downtrend, so I wouldn't buy that right here. This one is still kind of consolidating. AGL, this is the one I really like. Kind of popped up, did that. So I like that. And that's a small cap company. Weiss Market's a small market company, right? Earnings kind of gapped down reverse, went sideways, made a new high here, and then recently made a new high on Wednesday. So I like how that looks going forward. CarMax, don't like it right now. IC Zoom is consolidating after a long-term downtrend. So I just look through all these charts and I just say, okay, these companies are starting to maybe bottom out or whatever, whatever I see. Here's one that kind of Heritage Insurance, right? It had this earnings date, had a pretty sizable reaction to earnings, left this bottoming tail. Next day, kind of gapped down, reversed, and then kind of took off. So now it gave us this buy setup here at this 20-period moving average, right? And over the last 3 days has moved up. So it moved up from this moving average from about 14, a couple points up to 60, closed at 1623 Friday. Just made a slight new high. And one thing I'm looking for on these is we've got this buy setup. So let's say you missed this, right? You missed this buying opportunity here. You missed this buy setup, and now it's moved up. I like that this candle on Friday is fairly small when it made a new high. If on Monday or Tuesday this price just kind of consolidates here, I like that as a buy going forward. It could also retest this area down here. I would say that would be looking for value in that area. But when we get this move up and then we get kind of these lower range candles, that gives us a little bit better risk to reward because if we buy here, place our stop, let's say down here. Let's just look at those numbers. Let's say we buy here at 1640 and we kind of place our stop somewhere below this candle. Let's say we place it at 1540. Okay, so that gives us $1 of risk using a stop loss strategy. And then you just size accordingly. If you want to risk $10, you buy 10 shares. If you want to risk $50, you could buy 50 shares, right? Or whatever suits your budget. So that's why these smaller candles after move up are kind of important because you can manage your risk to reward. That one I don't like as much because it had a move down into earnings and it stayed down. So that's just a watch. This one is still like a stage 1, real long-term stage 1 there after downtrend. That's back and forth. That's in a downtrend. That's still kind of consolidating in a downtrend. This one, Walgreens, similar to CVS, but I like the chart more on CVS. Now, Walgreens has some interesting metrics about it. When we look at the performance of Walgreens, a lot more red, right, versus CVS. This will be a direct comparison to CVS because they compete in the same industries. A lot of negative stuff for Walgreens, right? 1, 3, 5-year returns negative, underperforming the market, negative earnings growth, and it just doesn't look good right now for Walgreens, right? Ratios, yes, it's got a low price to sales ratio, fairly low debt to equity, fairly low price divided by cash flow, very low PE. So this is where PEs can fool you. If you just bought on PE ratio and you said, well, Walgreens is cheaper versus CVS because it has a low PE, right? 4.95 is very low trailing 12 months, and PE forward at 6.6 is also very low. But there's a reason for it, right? There's reasons for this stuff because they've had such underperformance and they even have a negative profit margin, right? So Walgreens has been punished because they're not performing. Now, if you bought something just based on, well, I like Walgreens because, I like the company, I shop there, and they pay a high dividend, right? They pay almost a 7% dividend. So this is a company that, if you like dividends and you bought based on yield, then you also have to consider the underperformance, right? The negative dividend growth, negative earnings growth, right? You have to consider the negative profit margin. Yes, it has a low PE, and yes, it pays a high dividend percentage, but the company's really struggling, and that's reflected in this chart. Let's go to a longer term chart. And I think you'll see why I like CVS better than Walgreens at this time. Because Walgreens is still in this long-term downtrend, okay? So when we're comparing apples to apples, and we're comparing, Walgreens performance versus CVS performance versus the market performance, we need to take the whole picture into account. So I think that's enough for this video. I hope that gives you some comparison tools that you can use for yourself. And let's wrap this video up here. And just remember, guys, do some homework. And remember, start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. Thanks for watching, subscribing, and sharing this channel. I appreciate your support, and we'll see you in May of 2025.